All right, so let's talk about cash. Cash, as you should know, is the first item on the balance sheet under current assets, and it is also the most liquid of company assets. In fact, that's why it's the first on the current asset list. And kind of what comes along with that is a company's, we'll say, challenge of keeping adequate control over cash. And so when we talk about the asset cash, we also have to consider concepts such as fraud, and then what we're going to introduce called internal control procedures to hopefully lower the chances of fraud and keep accurate controls over our cash and other assets. So that's going to be the focus of this chapter. We've got some learning objectives. There are a lot of them. We're going to take these in pieces. So we're going to talk about the first couple to begin with, and then we'll come back and grab some more of this as we go. So there'll be several video presentations to cover this chapter. All right, so internal control is not just something that a company can do because it's a good idea. It is something that a company can do because they are legally required to do so. The United States Congress has passed the Sarbanes-Oxley Act. That's just named after the congressman who authored the act. And it pertains to publicly traded companies. These are companies who sell stock to the public, okay, investors. And this act requires these companies, again, publicly traded companies only, to not only maintain a system of internal controls, but to review that system of controls and also to issue a internal control report as to the effectiveness of these controls. So companies can no longer have, at least publicly traded companies, no longer have the luxury of pleading ignorance when something goes wrong. So we need to talk about this idea of fraud, and your slide wants to focus primarily on employee dishonesty, but we have this thing called the fraud triangle, okay? And it's right here, and it's got three sides: opportunity, financial pressure, and rationalization. And I will tell you that each one of these certainly can pertain to an employee, but they can also pertain to the employer or the company. So when there is an opportunity to commit fraud, the chances of fraud going up, or the chances that fraud will occur, certainly do go up. So let's think about, from an employee perspective, if we don't, if we have a poor operating system, if we have money and other assets unsecured laying around, that creates opportunity. From the company's perspective, a lack of laws and regulations and this kind of a Wild West business environment certainly produces opportunity to commit fraud. Now, that's a different type of fraud. That would be financial statement fraud, but it's nonetheless fraud. Financial pressure. Employees will sometimes have heavy expenses. They might live beyond their means. When that happens, the chances of fraud being perpetrated by those employees certainly goes up. Guarantee you they'll at least think about it. But companies also have financial pressure to meet earnings projections and so forth. So there's financial pressure for both. Rationalization. An employee might make the argument that, hey, I've worked here for 12 years, I've gotten one raise. So they'll use fraud to kind of give themselves their own raise, not sanctioned by the employer. From the rationalization from the company's perspective, they might have some financial statements that don't look very good. for the quarter, for maybe the second quarter of a year. That's the second 3-month period. And they might rationalize that they should misstate their financial statements because things are about to turn around and lying would actually produce a more accurate picture of the company's health than telling the truth. So we can have all three of these components of the fraud triangle that would apply either to an employee who's looking to steal from the company or an employer who is looking to present the company in a brighter light than what is current reality. So internal control are strictly methods and measures adopted to safeguard assets. Doesn't mean that they're not going to get away from us, but we're going to try to keep them. We're going to try to safeguard them. Enhance the accuracy of accounting records. Okay, make sure they're fairly presented. Increase efficiency of operations, and if we do that, we should both make more cash and save cash in the process. And then finally, we got to make sure that we have controls in place so that we're adhering to laws and regulations, paying our income tax and so on and so forth. We don't want to get fined because we're not in compliance. Internal control can help a company do all four of these things. Okay, we've got a little review question here. Internal control is used in a business to enhance the accuracy and reliability of its accounting records. We just talked about that. And we look A, B, C, and D. Well, the only one that was on the previous slide was choice A, safeguard its assets, so we know that's right. Internal control helps to prevent fraud, but it cannot absolutely guarantee that we're going to prevent fraud. We're not going to produce absolutely correct financial statements necessarily, but we can produce financial statements that are at least fair. And then internal control in and of itself, I don't know that it would deter employee dishonesty. It might deter a dishonest employee from acting on their dishonesty, but choice D is kind of a weird one, but safeguarding assets is the answer that we're looking for here. All right, we've got 5 primary components of internal control, and we're going to talk about each one of these, some more than others, but you will find these 5 components. I might change the order of these 2 here, but other than that, you can find these in any financial accounting textbook, any auditing textbook, so on, and they will all have the same meaning. Okay? All right. So let's look at a couple of these, and then we'll go ahead and cut this video off. The control environment is the overall attitude about the importance of internal controls. This is sometimes referred to as the tone at the top. What is management's philosophy and operating style? Do we have a style that emphasizes the importance of internal controls or the importance of making or meeting earnings expectations? Because if it's that second one, we have a weak control environment. The company's organizational structure, do we have one very powerful person at the top, or do we have input from lots of different groups? If we have one person at the top, we're probably going to have a weak control environment. And then personnel policies. All of our policies, from hiring to training, evaluation, compensation, fair promotion, fair compensation, avoiding conflicts of interest, all of these types of things, the more emphasis we place on doing this right, all of these things down here, the stronger our control environment we would have. Okay? Risk assessment, we're going to end the presentation after this one, and then we'll start a new video. All businesses face risk, competitive threats, regulatory changes, changes in customer taste, I skipped over that one, economic factors, and management has to look at these risks and determine, okay, if this happens, what is the significance of it, and then also what is the likelihood, okay? And if we have something that is significant with a reasonable likelihood of occurring, then we have to take actions to minimize those risks. Otherwise, we are not properly accounting for risk to cash. All right, let's stop this presentation and we will pick up with a new video after this.